Excellent. Well, great to be here. We have a great set of guests on our panel. So why don't we just get started with some quick intros. So I'm Matt Stafford, lead the business development function for Circle, covering everything from Arc to our developer platform to our exchanges and liquidity business and our AI initiatives. Maybe Julian, if you want to go next.
Julian Pierce, Director of Prime Sales at Anchorage Digital, helping build out our prime brokerage business, as well as been our lead on all of our Hyperliquid initiatives here at the firm.
My name is Frank. I lead North American fintech sales at BitGo, mostly serving banks, fintechs, and payments.
I'm Amar Kuchinad. I'm CEO at Copper, leading the company and focusing on driving our exchange and trading venue integrations for our Clearloop product.
I'm Ravi Doshi. I co-head the markets division at FalconX, which covers all of our over-the-counter spot derivatives and credit businesses, as well as all of our on-chain activity.
Okay, so to kick it off, most of you in this room are likely navigating some version of the same question. Your clients probably want access to interesting kind of crypto assets and investments. Your competitors are probably diving in headfirst and making some real headway. For those of you on the panel who work with traditional financial institutions, which obviously I think is everyone here, what separates those institutions who are making real progress with digital assets from those who are somewhat paralyzed and almost seem to be kind of like stuck in the mud? Is it top-down mandate? Is it client pressure? Are there specific product innovations? What's the sort of inertia there? Maybe I could start with Julian on this.
Yeah, it's a really good question. I think from our perspective at Anchorage Digital, everything is driven by our clients, what they're asking, what they want to see from us. And that always starts with the regulation that's in place, as well as the mega trends in the industry. So from a regulatory perspective, Clarity Act being passed is obviously going to be a major catalyst for banks getting into space, and something that I think we've seen post-Genius Act for fintechs and payment companies getting into space. And then even from an Anchorage Digital perspective, where we're now a major stablecoin issuer, partnering with firms like Western Union, Athena, and Tether on their US stablecoin USAT. So post-Clarity Act, we would anticipate a lot of these institutions are, specifically the GSIB banks getting into the space, they're all sort of have their own approach to it, but I think it's a three-pronged approach that all of them are taking, which is what are we going to do for our institutional clients in the prime brokerage business? What are we doing from a payments perspective on the stablecoin side? And then how are we going to allow our retailer wealth clients to buy, sell, and hold crypto assets? And so I think post-Clarity Act, all of the large GSIB banks will get into space, and that will bring a lot more of the institutions into the industry. And then I think from a major trend perspective, obviously stablecoins being one, which I talked about from a Genius perspective, but then tokenization as well as perpetual futures. So from a tokenization perspective, I think an announcement yesterday with DTCC and their tokenized equity program. You see NYSE and NASDAQ getting into tokenized equities as well. And then obviously Kalshi and Coinbase from a perpetual futures perspective. And so from what we see and what we're hearing, it's really all about how regulation is moving these firms into the space, and then how these trends of stablecoins, tokenization, and perps are really driving that adoption forward.
Anyone want to add on to that?
Yeah, I think from our standpoint, we take a very TradFi approach to this, maybe because of most of the leadership's background and where our investors, our shareholders care about, plus our client base. And I think even more than Clarity Act opens up the $2.5 trillion crypto asset class to some of the traditional institutions, but $2.5 trillion almost doesn't move the needle for a lot of them. I mean, we look at the results that JP Morgan and Goldman Sachs and Morgan Stanley are announcing in equities, and you can see that no one's going to get fired there when they don't make $200 to $500 million facilitating trades in crypto assets. But what really seems to be the big push is this idea that this technology has been demonstrated to work at scale for institutional traffic in crypto, which means that it can work at scale for other asset classes. And I think it opens up a lot of new avenues that people are excited about, 24/7 trading being the least of them.
I think what I'd add is when the opportunity is large enough, we see these traditional institutions willing to move mountains to execute on that opportunity. And in particular, there were two specific instances over the past 6 months where FalconX stepped in as the facilitator of access to hyperliquid markets. And one being during the Iran war, a client of ours on a Saturday morning wanted to trade oil and trade it on leverage, and was able to do that in part due to the fact that Hyperliquid offers that product. And then secondly, the pre-IPO product has been pretty revolutionary because finally VCs and large holders of these private equity positions can get price discovery at any point in time and hedge these positions out. And so we've seen quite a lot of activity in Anthropic and SpaceX and SK Hynix as well.
Great. So let's now move on to some of the concerns, and let's be real. You know, there are still concerns in this space that keep a lot of folks up at night. Things like custody risk, counterparty risk, reputational risk if something goes wrong. These aren't soft concerns. They're not made up. They're all driven by real-world events where things have gone badly wrong. So from your seats, where does it make sense for institutions still to be cautious versus, you know, where are people sometimes using caution really as a proxy just for not making a decision and kind of getting stuck in the mud? And maybe, Frank, if you want to start on that.
At the risk of seeming glib, this answers your first question too. It's a lot of fear, followed by bureaucracy, and sometimes the two are intermixed. There's fear of counterparty risk, not to use four-letter word in polite company, but compliance is what stops a lot of this, especially when it comes to interacting with DeFi. How do you, as a regulated institution, and by that I mean our clients, interact with largely unregulated DeFi in a safe, compliant way that's not going to make your AML officer have an ulcer? We're trying to figure this out for our clients, how to give them access to the liquidity that lives on DeFi in a permissioned way, in a way that is safe in terms of security of the assets as well as counterparty risk. It's not an easy thing to solve, and I don't have answers, but we are looking hard at it.
That's great. Anyone want to add to that?
I think there is this fear of the unknown. I think that beyond that also, again, it comes to, as a former trader, I can sort of relate to discontinuous risk is unhedgeable, right? So things going from something to zero is something that you cannot trade your way out of. And we saw that in 2022 when things went from, you know, you had some assets on a trading venue to you have zero assets that you can access on a trading venue. And so I think what the market and what a lot of these participants are looking for is, from the institutional standpoint, a more robust regulatory regime, not regulatory regime, but more confidence in how things operate. That you know, you can't have sort of whimsical decisions being made about a contract that takes it from one price to another price because of some decision that was made, right? And so I think that again leads to a lot of the confidence in the market as we start establishing these standards and get people more comfortable with how a lot of these products work.
Yeah, that's great. Tons of innovation, and these things are being seemingly kind of solved piece by piece, which is huge innovation across the industry. Now, coming on to kind of, you know, Hyperliquid more specifically, and just, you guys are obviously very involved in, you know, you see a lot of the order flows first, you see them early. What are you kind of like seeing right now in terms of, you know, the biggest activity, and how do you see that activity really transforming over the next year? And Sterling talked about some of this. Obviously, real-world assets is a big, you know, growth driver. But yeah, I guess like maybe Ravi, if you want to start with just some thoughts on how you see the demand generation side of things evolving going forward.
Yeah, so I think what our clients are asking us for is a regulated wrapper and a way to get access to this liquidity by facing us and not having to directly face the exchange. And because we are a heavily regulated institution, they like that, and that's perfect for them. But then on our end, we spend an inordinate amount of time and money to maintain and obtain those licenses. And so there's this chicken or egg situation where it's like, okay, well, we want to prove out that this business model can work and we can do it, but at the same time, we don't want to risk these licenses that we have that give us the ability to operate at scale with these large institutions. But what I do see is clients coming to us to ask us for that access, and whether it be for perps on crypto versus perps on traditional securities, I'm actually seeing far more demand from these institutions to get access to traditional markets. And that to me was somewhat surprising, but it does make sense. And I think Amar made the point earlier that the crypto market is just still very small. And so what Trade XYZ has done by opening the floodgates, and Hyperliquid, of course, to these larger asset classes is what's made it so much more interesting for these institutions to actually pay attention to this arena.
I would second that as well by also saying that a lot of these hedge funds that have been primarily crypto native want the ability to trade these tokenized equity products and to get exposure to products outside of just purely crypto. Crypto, obviously we're in a bear market and things have been pretty down bad, but if you have the ability to touch other assets, the pre-IPO perps or tokenized equities or index products and things of that nature, it really makes their portfolio a lot more attractive to institutional investors as they look to raise capital.
I hate to go back to like the individuals at these big institutions, but I think a lot of this gets driven by job preservation. And like there is literally, I challenge anyone in this room to find more than 5 people at a bank who will get fired for not having a crypto business. But I can guarantee you there are at least 100 people at every big bank who will get fired if they are unable to service their clients in equities, whether they're pre-IPO or post-IPO, or on corporate bonds or treasuries, in the same way that blockchain-based markets can. And so I think a lot of what's driving that is this fear of missing out on their existing business, migrating to a technology that they just aren't ready for. And so I think that a lot of them are spinning up and getting ready for that, working in partnership with companies like ours who have done the hard yards of figuring out how to get a regulated institution into a space that has been largely unregulated to date.
Amazing. Great answers. So Hyperliquid, as everyone knows here, probably generates more fee revenue than any other protocol in crypto today. And it's all visible on-chain in real time, so that basically anyone can go and see how much revenue is being generated. And that revenue is obviously being used to buy back Hype via the assistance fund. Big institutional investors are still pretty much steeped in annual reports, earnings reports, and kind of like traditional audit reports. But this whole kind of like transformation towards being able to actually look on chain and see real-time revenue and actually verify that for yourselves is quite a big innovation. I guess the question for you all, how quickly are institutions evolving towards a mindset where they actually trust the kind of like self-verification of revenues and performance on chain versus still kind of like relying most heavily on kind of like traditional reporting?
I think some of that, there's 2 factors to that. We've seen over the last 10 years that alt data is a big driver of investment decisions, especially among the alpha-seeking hedge funds. And so they are not relying on financial statements. On the other hand of that, like that's a relatively small community in the traditional asset space, right? So the amount of AUM that they have versus what passive index and long-only investors have gets dwarfed. But I think on the other side of that, we haven't had an event that calls into question, at least in developed markets, those financial statements like we did in the early 2000s, right? I think if we saw another Enron, we saw another WorldCom, we saw a Parmalat, you would start to get people more interested in, hey, the on-chain transparency is better than these financial statements. In the absence of that fraud, if you will, then I think the market doesn't see the advantage and the need to develop the technology to go look on-chain for this data. And by and large, there's not a lot of companies, the investable universe where on-chain data can drive an investment decision is very small. And so there's a little chicken or egg problem like Ravi was talking about whether you actually spin up all the capabilities for a very small investment opportunity.
I will say that several months ago, even last year, the idea of using fundamental analysis to invest in an on-chain asset or invest in a token was laughable. But then now you see TradFi analysts who came over from the sell side or the buy side now actually applying some of those frameworks to on liquid token investments. They're looking at revenue, right? Who was investing in revenue a couple of years ago? You were just kind of buying on hype. Now you're looking at actual revenue, actual usage. They're different metrics, but it's still a fundamental numbers-based analysis. And you're seeing that kind of, I think, knowledge base come over from TradFi into this space.
I think it's generally a lot easier to underwrite an exchange business. You can see the revenue, you can see the volume, you can see the open interest. And then additionally, there continues to be catalysts or new product launches that puts Hyperliquid in the headlines. You know, HIP3, HIP4 exchanges making it the everything trading app, price discovery from SpaceX pre-IPO perps, and now even obviously the perps on the Chinese chip making equity products. So it's and not even to mention the over $1 billion in daily volume for the oil market perps as well. So it just continuously is in the Wall Street Journal being cited. It's continuously top of mind for a lot of folks in the industry. And then if you bring it back to everything my other panelists just mentioned about how it's much easier to underwrite and how traditional financial analysts are actually looking at the revenue and things of that nature, it just makes it a lot easier of a story to sell internally.
I do think that it's great that we're sharing this. We have the ability to provide this data in real time. However, the value of the quarterly earnings calls is, in fact, the management's nuanced opinion of the business and the market landscape. So what I would love to see is more and more crypto protocols running those types of traditional quarterly earnings calls so that the investors and stakeholders can ask the questions that they want to ask from the people building the protocol to better understand what the future of the protocol looks like.
And if this stuff isn't considered a security, then you don't have to worry about Reg FD or anything like that. So why not?
Yeah, no, it's great. I mean, it'd be super interesting to see how this evolves over time. And again, Hyperliquid is leading the charge on this front, but I expect more and more, platforms that are blockchain based and are actually generating a lot of their revenues on chain will head in this direction. So a question now about kind of like what keeps you up at night, and really almost kind of like getting into the heads of folks across all types of institutions in the room. Two sides of this. One, what would be something where you look back and say, we didn't move fast enough, we got left behind? What would be one of those situations? And then equally, what would be something that kind of like where you kind of look back and say, we moved too fast, we did something too drastic, we kind of made a big play that was a little bit too early. And as you answer this question, maybe you could kind of talk about some of the things that institutions should be doing now, so that in 2 years' time they're actually not looking back and thinking, they're in a position where it's a matter of emergency. Maybe we could start, Amar, if you want to kick that off.
Yeah, I think it's difficult to make decisions about specific products because those tend to be very cyclical. I think what I would say is a risk and that people should be worried about is underestimating the power of the technology underlying this and the speed at which it could be adopted, not by mainstream finance, but by this alternative to mainstream finance. And I'm very much a traditionalist. People who work with me joke all the time that I should have maybe stayed in TradFi. But I don't think that we're going to be able to make Bank of New York go out of existence. They've been around since 1787, have seen a technology called electricity come into fruition while they have been in existence. But I do think that they do risk being left behind, not Bank of New York specifically, but these financial institutions, if they don't start getting ready for blockchain technology and incorporating that into their workflows and thinking about how the sexy parts of 24/7 trading need 24/7 infrastructure underneath it, and how would they actually not only set up the technology, but their processes, their people, their geographies, their regulatory entities for that. And there's a bunch of people up here on the stage who've gone through a lot of that brain damage over the last 10 years, and especially over the last 3, who I think bring some of that expertise already.
They got to start hiring, to your point, right? The banks have to start hiring for expertise. The TradFi institutions have to hire. You're starting to see it, actually. You're starting to see banks and traditional market participants hire degens. Where else are they going to get the expertise? You're going to hire McKinsey? I mean, no offense to McKinsey, but like I can't see it. Them having years of institutional experience in this. the talent pool's not that deep. So I think it's going to be competitive as these TradFi institutions figure out how do we get people in the door that know what they're talking about.
I think a lot of it too starts with the infrastructure around how you're actually going to be touching and holding onto these assets. So that's obviously very relevant. Sitting at Anchorage Digital as the first federally chartered bank and qualified custodian. So having a lot of these conversations with the banks about what they're looking to do. As I mentioned, everyone is taking their own approach. Everyone's going at their own speed. But at the end of the day, they need to figure out how they're going to be touching these assets and the operational differences internally between the processes and the security that differentiates between the traditional prime brokerage models. And so it's really interesting to be in my seat where I get to have the conversations with these banks to see how they're thinking about it, how they're thinking about cold storage versus self-custody, how they'll be using it across whether it's payments or the institutional side, as well as educating themselves on the risk mitigating tools that have become available over the past few years. So at Anchorage, we have Atlas, which is a suite of risk mitigating tools that has our off-exchange settlement solution, 24/7 collateral management, tri-party, DVP settlement, and things of that nature. So while it's fair to be cautious, while it's fair to wait until Clarity Act, it's probably not a great idea to not be educating yourselves on the tools that are available and to see how much the industry has transformed over the past couple of years.
I would say at FalconX, we're doing all the boring stuff, which is legal entity creation, credit counterparty frameworks, compliance frameworks, and then capital flows, like how will capitals flow between our regulated entities and our unregulated ones that allow us to remain compliant and still be able to offer the regulated institutions the product they want without tripping up any of our requirements.
Awesome. So I think we've got time for one more question here. And this is a bit more about just kind of like Hyperliquid beyond the side of Hyperliquid that most folks know. So obviously everyone's familiar with the perps exchange, the spot and perps exchange, but Hyperliquid actually has a pretty interesting stack. When you look across the EVM, which obviously supports stables, DeFi, lending markets there. You have HIP3 where, builders can kind of like stake and they can, set up permissionless markets. And we've seen the whole kind of onset of tokenized equities and commodities and things like that. And then obviously the whole thing is secured by people staking Hype through the validator set. So I guess, what are you seeing in terms of kind of like, investors looking at the stack beyond the perps exchange? Is that happening today? And I guess like, when you look forward, what parts of the Hyperliquid stack do you think are going to become increasingly interesting to constituents?
I'd be happy to take that one. So from our perspective, it's always been about ecosystem support for new chains, new dexes, and things of that nature. So even on the Anchorage venture side, we've written checks into firms like Kinetic and have partnerships that will be announced shortly with firms like Hyperland and things of that nature. So it's always around not just supporting the chain themselves, but also the people that are building around it. Also at Anchorage, we have the ability for clients that, where a lot of the large Hype holders are custodying and staking with us as well, have the ability to link their staking account to an external trading wallet to give them that diamond fee tier discounts while trading on Hyperliquid directly. For us, it's a little bit easier to provide a product like that rather than them directly connecting into a federally regulated bank or an MAS licensed Singaporean entity. We continue to build out new products like that will support the large Hype holders as well as the ecosystem, whether it's on the Hype EVM side or just the large institutional investors with large Hype holdings.
I think one of the most interesting things is how the protocol has developed technology that operates at a latency that allows to run a modern trading venue comparable to some of the top tier exchanges and have instantaneous clearing coupled with it. I mean, I have to imagine that as we talk about 24/7 trading and risk mitigation and the $1.5 trillion of liquidity that's trapped as collateral on derivatives globally, that you start thinking about, okay, how can we make that more efficient? How can we unlock some of the capital that's allocated there to be used for better purposes? And so I think that that's, where I don't yet think that enough institutions are thinking at that level or looking at Hyperliquid and seeing what it has, but I do think that that's a natural path over the next 12 to 18 months.
I would say the global price discovery of things that were generally not able to be priced is the biggest value add right now. That I'm like across all of my clients, they the fact that you can trade Anthropic today is a big step change that Hyperliquid has allowed us to achieve. And so that to me is I think the biggest factor. But then also there's a ton of demand for margin. People are looking to us like to borrow capital to then trade on Hyperliquid. So I could see that also becoming a bigger build out, whether it be through Hyperlend or otherwise through institutional wrappers like ourselves. But those two things are key components.
One thing I think we all have in common here is we have 4 regulated institutions on stage, and we all have clients looking to engage or access this fast, efficient liquidity through a regulated entity. You're going to have investors come in because they want access to an asset that they can bet on or bet against. Increasingly, though, I think you're also going to see non-investors come into this, and that meaning banks and payments who are looking to move money, not necessarily make an investment. I'm actually interested to see what happens on the stablecoin front with Hype, with payments, with this very fast, very efficient decentralized ledger being used to actually perform or effectuate payments, or effectuate large amounts of data being stored and moved around and made publicly accessible. I think the use cases there extend far beyond investments into things like supply chain, into things where there's a lot of data that needs to be collected and put on chain and made accessible. I think it's going to be nascent, but we're starting to see signs that, hey, other industries who you wouldn't really think of as wanting to engage in an on-chain or digital ledger are coming into the game.
Awesome. Well, just want to thank all of our panelists. Great to have you all here, and looking forward to a great day. So thanks, everyone.
Thank you.
Hyperliquid.